Diane, I'll start with you. A lot of the focus right now seems to be on what happens with the dot plot and whether we see a move up into 2023 for a first rate hike. What are you expecting? Do you anticipate that could be the case this afternoon?
Well, I think that Elon certainly hit the nail on the head in terms of dissonance within the Fed, and that there are some that are now worrying more about whether or not how much of the flare in inflation is just a flare and how much is persistent. And I do think we're going to see at least one of the participants at the meeting move into 2023 in terms of the time frame. That still puts the majority outside of 2023 and after. But I think it's an important move, and you may see some of those within 2022 and 2023 already, the seven that are already there, starting to move up their rate hike expectations. And that will still be dovish, but I think it's an important shift for the Fed to acknowledge that even though the economy is performing much stronger than they thought, inflation's performing much stronger, but on the downside, they're disappointed, and Chair Powell will make this point on the progress in employment.
Samir, what's priced into the market here at these levels right now? I mean, I realize we're slightly lower on the S&P, but we're still right near record highs. If you start to see even the slightest bit more hawkish tone, or I guess even whether it's a move in the dot plot, whether it's talk of tapering, could that actually change the dynamic for the market this afternoon?
So what we would say is we think the market's actually leaning a little bit towards a hawkish surprise. So what the real surprise could be is on the dovish side, right? If the Fed says, look, we're going to stick to our guns, what you could see is, rates kind of move higher a little bit from the standpoint of the curve steepening. You could actually see stocks really, truly break out, right? They've been range bound for almost 3 months now. And, the real takeaway should be no matter what they do today is, we just recently released our mid-year outlook, and it's titled Fuel for Growth. What most investors will need to focus on, in addition to the Fed, is you've got a really good backdrop for equities over the coming 12 to 18 months. So if there are any disruptions in the near term here, people should be stepping in and buying stock.
Diane, I want to get your thoughts on the labor market and the fact that this is certainly dictating and driving Fed policy right now. I realize we still have millions of people out of work. You have a record number of job openings as well. Something that is perhaps not being discussed as much right now is the skills mismatch, which was in existence before the pandemic and has arguably just been exacerbated by it. Can the Fed actually affect that or change that dynamic with policy right now if that is part of what is driving people from coming back into the workforce?
Well, the Fed has been pretty clear in terms of, after their Fed Listens events, which I attended many of, is that they realized that as the economy, the labor markets got much tighter, that many people who would not have been given a chance were given a chance, and the net was cast much wider by employers. And I think that's very important. You'll see Fed Chair Powell talk today about the fact that we now have people who are disconnected from their previous employers, and they have to actually search for a new job. And that's an important issue. I think it's also important that we are seeing this step up in wages at the low end of the scale, driven mostly by large corporations, which has made it very hard for smaller businesses to compete. That means a concentration of wages at large corporations, which at the moment could be a step up and be better for low-wage workers, but going forward could mean less dynamism in the U.S. economy and could undermine the powers of workers to be able to demand higher wages going forward. And so he's going to be juggling those issues. The Fed has also been looking at the retirements. How many baby boomers over the age of 65 appear to have left the labor force entirely, most of them with less than a high school degree. These are many people who are working those frontline jobs, and that makes it easier to get to full employment sooner. So this is a tight wire, and there is only so much the Fed can do. All they can do is run what they call a high-pressure economy, something that Janet Yellen once coined the phrase of, and that means overshooting a bit on what they thought was full employment. But it's a little different in these uncharted waters. And the question is, how much of the inflation we're seeing is transitory? What is transitory? How long is that? And on the other side of it, what's more persistent?
Shepard Smith here. Thanks for watching CNBC on YouTube.